This is EquityZen's 11th diversified growth fund. It's structured as a Delaware Series LLC with Series 1 for accredited investors, Series 2 for qualified purchasers. Minimum investment is $50,000. Investors receive membership units in a multi-company portfolio targeting 15 to 25 late-stage private companies. Let's evaluate this through 5 lenses: strategy, portfolio construction, marketing claims, fees, and structural risk. 1. The strategy. Late-stage, venture-backed growth. The mandate is clear. Invest in equity or equity-linked securities of late-stage private companies that have valuations of at least $500 million, completed Series B, or later raised more than $50 million, are backed by established venture capital firms, potentially exit within 5 years. They explicitly exclude biotech, pharma, and medical devices. So this is primarily growth technology exposure. This positions the fund in the late-stage venture as pre-IPO ecosystem, not early venture moonshots and not buyout private equity. The appeal is simple: access to venture-backed private companies without needing institutional-scale commitments. 2. Portfolio construction. 15 to 25 companies. The fund expects to hold 15 to 25 investments. That provides diversification compared to single-company SPVs, which reduces idiosyncratic risk. However, portfolio companies are not predetermined. The manager has sole discretion. Allocations and pacing are fully manager-driven. This is not an investor-negotiated structure. It is a manager-controlled pooled vehicle. 3. The marketing angle. 67% backed by leading VCs. EquityZen markets that 67% of prior growth opportunity fund portfolio companies were backed by leading venture capital firms. On the surface, that sounds reassuring. Institutional backing often signals professional diligence, capital access, governance, discipline, exit pathways. But here's the nuance. Being backed by leading VCs does not eliminate valuation risk. It does not guarantee IPO outcomes, and it does not protect against late-cycle entry pricing. In fact, many late-stage venture-backed companies from 2020-22 vintages have since repriced materially. So while VC sponsorship can be a positive signal, it's not a substitute for entry price discipline, secondary discount capture, or portfolio construction rigor. For sophisticated allocators, this stat is helpful, but not determinative. 4. Fees, the real economic story. Now let's talk economics. Management fee, 1.72% to 2.75% annually, depending on commitment size and closing timing. Smaller investors, likely at the high end, 2.5% plus. That is higher than many institutional growth equity funds. Carried interest, 15%. That's lower than the traditional 20% venture carry, which is competitive. So structurally, the economics lean toward higher management income, slightly discounted carry. Over a 5-7-year hold period, a 2.75% annual fee meaningfully impacts net IRR, especially in a strategy where liquidity timing is uncertain. For smaller accredited investors, this fee tier matters. 5. Structural considerations and risk. This is the Regulation D private placement. There is no redemption feature. Investments are illiquid. Distributions are subject to reserves, expenses, manager discretion. The manager may also accept or reject investors, waive or reduce fees for certain members, allocate opportunities at its discretion. Additionally, this is a speculative investment strategy. Loss of capital, including total loss, is explicitly disclosed as a risk. Diversification does not eliminate that risk. 6. So who is this for? This fund may make sense for accredited investors seeking diversified late-stage exposure, investors without access to institutional VC funds, long-duration capital comfortable with illiquidity, those valuing curated access via an established marketplace. It is less compelling for investors sensitive to management fee drag, allocators who already have top-tier venture access, anyone requiring liquidity, flexibility, investors who prefer tighter governance rights. Final Take EquityZen Growth Opportunity Fund 11 offers diversified pre-IPO exposure. access to VC-backed companies, lower than standard carry, marketplace sourcing advantage, but also higher management fee tiers for smaller checks, illiquidity, heavy manager discretion, marketing signals that require deeper underwriting. The 67% backed by leading VCs statistic is comforting, but sponsorship alone doesn't determine outcome quality. At the end of the day, this is a convenience vehicle for accessing late-stage private growth exposure. The core question is, are you paying for access or paying for alpha? And at 2.5% plus, that distinction matters. If you want deeper allocator-style breakdowns, including modeling fee drag and comparing these vehicles to institutional venture funds, subscribe to Private Roots. We analyze alternative investments the way institutional capital does. See you next time.